Good afternoon. Welcome back to the weekly market review for the week ending March 22nd, 2024. And the topic for this week is that the Fed has basically opened the door for more upside. They were dovish as ever. We'll jump into it in just a minute. But first, don't forget to hit the like button and subscribe to the channel. If you are not already subscribed, you can also follow me on Twitter at Mr. J. Thomason. And you could follow my free weekly newsletter coming out every Sunday morning at 11 a.m. Eastern Time at befinanciallyfree.substack.com. And the links to both my Twitter and my Substack are in the description of the video below. And I do want to point out the subtitle of my last post from this last Sunday was that the Fed may bring volatility or another boom. And so in the newsletter, my base case was that we would actually see downside on the week. That did not happen, but I do acknowledge that there was decent enough setup for if the Fed was to be dovish, that it would actually allow assets to go up, and that's basically what's happened. We'll take a look at that. So before we do, let's take a look at where the S&P is. So looking at the S&P E-mini futures, we're just shy of 5,300 there. That's obviously different from what the S&P 500 index is at, which is closed at 5234. But again, I always tend to look at the futures pricing. So we were up on the week, up pretty substantially, over 2%. On the heels of a strong early part of the week, and then we obviously had the FOMC day. S&P was up, but although I would say though too, one thing that stood out to me was that it wasn't quite up as much as it has been at other FOMC meetings. And so, for example, back in December, the S&P was up over 60 points back in December on basically where the Fed reiterated that cuts were likely on the horizon. Back in the November meeting, we were up pretty substantially. I mean, we were up this last time, we were up 45 points. I guess given how dovish the Fed was, and they were extremely dovish, I just was surprised that the market wasn't up higher. It's boomed on less dovish news before. I know that some of that has to do with positioning, so I'm just kind of thinking out loud here. But in any case, the NASDAQ futures was up on the day, barely. By the way, most markets closed. Most of the equity markets closed down today. NASDAQ did close positive, but barely so. And this is on the heels of yesterday. The gapping up, at least if I were to go to the NDX, which is the NASDAQ 100 index, we gapped up, but actually closed down from the open, which I thought was really interesting. A lot of that had to do with the price action in Apple. Yesterday, Apple dropped 4%. Today went up, but only about 0.5%. So Apple has not been doing well. It's been an underperformer and has yet to make a higher high since basically middle of December. Interestingly enough, the day after the December FOMC meeting was the last time Apple had a really strong day. So anyway, back to S&P for just a second. You can see I have this trend line here. I'm marking this trend line because basically I've had a multiple different trend lines. I think this has got to be the trend line for now because we continue to make higher highs, and this is the lowest connecting tick here from early March, earlier this month. This is kind of what I'm watching to see. I'm watching for the first potential breakdown. Obviously, we could put a trend line, right about. Let's see, we could do it right about there as well. So I'm willing to watch both of those, but obviously for now, I'm watching this base trend line. Just for support watching, I mean, you can just kind of see every time we've gotten close to that trend line, the market has been bid. So what was dovish? So let's take a look at a few things from the week. Let me start with some economic data. Yesterday, the leading indices, or the leading coincident and lagging economic indices from the conference board were released, and the leading economic index, this was being talked about a lot yesterday, the leading economic index had its first monthly increase in like 2 years, or almost 2 years, here in the month of February. It was a small uptick, but what has been interesting, and something that I have been noting every time, so on a monthly basis I will include this this chart in my newsletter. Sometimes we look at the bar chart as well, and what I have been noting is that despite the constant negative numbers, what has been trending up, if you look in the top of these three panels and look at the blue bars, that they are trending to the upside. Obviously up and down, up and down, up and down, but if you go from the left to right, the trend is generally up over time. And that's been really interesting. What that's been suggesting is that, or what that's showing is that the rate of change on the downside is decreasing, decreasing, decreasing. And then here today we have this, our first positive value, which I was wondering if that would happen. And it's really interesting because for, almost 2 years, the leading economic index has suggested recession, and every time these readings have existed, there's always been a recession, and yet we never got one. And now the leading indicator is turning up, and we never got that downturn. And so there's a lot of like early cycle behavior that's happening and has been happening for a number of months in markets. Coincident economic index still strong as ever, still showing that the U.S. economy is currently booming. Lagging index still doing just fine. The economic data is supportive of particularly of stocks where they're at right now. So I just wanted to point that out. Now, I'm pulling up the dot plot, or I'm sorry, the SEP, which has the dot plot in it. This is the dot plot right here. I usually don't look at the dots themselves. A lot of people will get a kick. Like, let me just go back to it. A lot of people will point out, oh, there's, they'll talk about how many dots are in which spot as a sense of like the consensus of the Fed. But that's neither here nor there. That's largely irrelevant. What I look at is obviously the first table, which has the summary of projections for GDP, unemployment, PCE inflation, core PCE inflation, and the path of the federal funds rate. And if I told you that, immediately I talked about how I think I posted it on Twitter. I actually don't have any tweets pulled up right now, so I can't look. But on Wednesday, I posted that this is like the most dovish thing ever. So even before Powell spoke, you got the sense that on the whole, the Fed got more dovish, which is really interesting. For now, without any clear sign that the economy is deteriorating, markets loved that. That's why the markets went up. Here's one of the things that I've been pointing out from my own observation, and I wrote about it in my newsletter, and I've talked about it a little bit on Twitter, that my suspicion and my base case had been that because the inflation numbers haven't been good and that inflation had actually bottomed, that it was entirely likely that the Fed would revise their projections for the path of policy. I thought they were going to take a rate cut off for this year, and that they would definitely take rate cuts off for the next 2 years, in 2025 and 2026. And they did take, if you look at the bottom of this panel, they did take off a cut from the 2025 and from 2026, and in the longer run, the median shows that their projection for the Fed funds rate was actually a little bit higher. So what that's showing you is that the Fed is actually suggesting that over the long run that they project higher policy rate, higher neutral policy rates than normal, than it has been, and that's really interesting. So that's a hawkish move. But they left the Fed funds rate for 2024 the same, so that means they're projecting essentially 3 cuts. So what's dovish about that? So some would argue, well, they haven't gotten more dovish because the dots didn't change. Well, when you look at their projections for core PCE inflation, which are right here where I'm highlighting, their projection for 2024, year-end 2024, went up from 2.4 to 2.6, right? And then not just that, their unemployment rate, their December projection was 4.1. They brought it down to 4.0. And so their projection for GDP was higher as well. But the point that I want to make is two of the metrics that I've been talking about that to me suggested that there was no way the Fed was going to be able to, or like a low probability that the Fed was going to keep their, was going to actually cut 3 times in 2024, was because they were projecting a 4.1% unemployment rate and PCE inflation to come down pretty substantially, and that if the economy was not showing a trajectory of that, then there was no way they were going to cut. So what was crazy about this was that they actually lowered their standards for achievement here for cuts. So you actually really get the sense here that they really want to cut, because otherwise, they, like, how can it be that they raise their projection for inflation, lower their projection for unemployment, but keep their cuts the same? So they actually are really eager to cut, despite what Powell was saying in his press conference. That was largely irrelevant. What mattered is the market saw. I mean, if we go to let's go to a 1-hour chart. If we go to the 1-hour chart, you can see at 11. Let me go to, actually, let's do a 10-minute. That'll be a little bit easier. Right. So at 11, you had a huge jump. You had a jump in equities, and then Powell starts talking, and basically did not say anything hawkish to contradict what was being talked about in the what had been talked about in the SEP. He basically said, we still think inflation is going to come down. So that's what's wild about this. Like, they're still projecting that inflation gets to 2% by 2026, right? So that projection, interestingly enough, doesn't change. But in the near term, they think that it's going to be higher, and yet they still want to cut 3 times, despite the fact that financial conditions are extremely loose. And Powell talks about the tightened financial conditions through like the lens of like the housing market and various other things, that the labor supply is coming into better balance. But in reality, I mean, like, when markets like equities all-time highs, where are we? Bitcoin all-time highs, gold all-time highs, right? Like, it's not, the financial conditions are extremely loose. They are not tight. So it's just wild. So markets, I mean, in my opinion, it's obviously, you have to understand, like, just because the market has runway for more upside doesn't mean that there's not going to be corrections, because the corrections come from, over positioning, red hot sentiment. There can be all kinds of things that cause the market to come back. But for now, I mean, there's no reason between now and maybe the next inflation report. So we have PCE that's going to come out next week. That will still only be 2 PCE reports in a row that are unfavorable. So I suspect that it's going to have to be at least a few PCE reports that suggest inflation is not behaving before to change the opinion of the central bank. And so, in my opinion, obviously markets can correct, but there's no reason why this can't continue up at least for another month to a month and a half, in my opinion. Like, I think we're looking at, if inflation does indeed come in, like if PCE inflation is high in this month, for the month of February, and then if in April we get the March CPI, and March CPI is also hotter than expected, and then PCE for March released at the end of April shows higher than expected inflation, and then maybe we get the Fed to move a little bit, but even when it comes to rate cuts, we won't get another SEP until June. So at least a month and a half, if not 2.5 months, before we get any real sense that, again, if all things hold, if inflation is still elevated and if growth is still strong, we still might not get any sense that the Fed, or we still, like, it's still going to be a little while before we get any sense that the Fed might change that outlook. So, in other words, long story short, after all that babbling, equities have a pretty significant runway. So I say that cautiously because obviously, I've given a lot of bearish takes. So obviously, me saying there's a lot of runway for upside, somebody could, like, for all we know, next week could be the start of a 10 or 15% correction, and then of course, people are going to get on YouTube. This channel is a top picker and or a top buyer and a bottom seller, whatever you want to say. You obviously have to always consider your downside and be prepared for your tail risk and all that. But in terms of the economic story and policy, things look absolutely fine. So if anything is going to cause a market downturn, unless it's some sort of black swan or significant abrupt change in economic conditions, it's going to be technicals that cause that. It's not going to be economic or fundamental in nature. So I would just say that. Now let me talk about some things that might punch holes in that. I do think it's very interesting. So the dollar had a strong down day on an outside reversal bearish day on Wednesday on the FOMC decision. But then the last 2 days, we've engulfed that in a 2-day period. We've gone back above and got an up. It looks like we're about to continue an upward trend. And this is a little concerning to me because if you've been following this channel, you know that I was talking about back here in February, early and late February, or mid to late February, the risk that the dollar could make a bullish tide cross at the same time that the 10-year Treasury yield was making a bullish tide cross. And so I'm still concerned about this. I'm even more concerned now because if we make a higher high, if we have any significant upside next week, if we get up to the same level and make a higher high, this is going to cross. And I am not saying that dollar up means assets must go down, but it is a risk, right? It's a risk that they go if the dollar goes up, and then if yields also continue back up. Yields have had a down week. The 10-year yield had a down week, but did have enough to make another bullish tide cross last week, and that has maintained since. So bullish tide in the dollar and in Treasury yields is not usually a good recipe for assets, and so that would be kind of the cause for concern that there could be a correction. It was also interesting, markets closed down, VIX was up today. VIX is at really, really low levels still. This kind of broke the trend of higher lows, and so I'm not really sure what to make of this. Obviously, when the VIX is super low, it can stay low for a long period of time, but the risk to reward of short vol strategies is not as good. So I would say that, but again, doesn't mean that the VIX can't stay low and that assets won't still go up. I did think, let me look at the breadth really quick. Breadth had recovered a lot this week from its previous losses. We reached a multi-year high in breadth earlier this week, intraday, after making a high last week. But the last time we were at these levels was back in September 2021, and that was when breadth was on the decline. And this is of stocks above their 200-day moving average. So things can always get, the assets can always, or the rally can always broaden out more. But I did think it was interesting that we got such a sharp decline in the Russell. When you have these up days or these down days, in this case, the Russell is still not back to all-time highs yet, so it has been lagging the other indices, and so a lot of people have been buying the Russell for the catch-up trade, and so when that happens and then there's a market downturn, it makes sense that then the one that has been lagging is indeed the one that gets sold the hardest, and it's sold off more than 1% more than the lower than the S&P and NASDAQ went today. So I would point that out. Let's take a look at Bitcoin. I think this is a really important thing. If you are following Bitcoin and crypto, then you have to understand, you could go back way back in my channel when I was making videos kind of all throughout here. And obviously I got crypto wrong. A lot of people got crypto wrong during this period of time. There was a lot of stuff going on. It was not typical cycle behavior. But having said that, I mean, I haven't even studied more than anyone else, but I do understand that when Bitcoin does correct in its bull run, these corrections are often 20 to 30 and sometimes 40%, and they take a long time to resolve. I mean, like I'm going to go back to a more normal, a quote unquote normal cycle. Let me turn my log scale chart on for a second. If I just go to the 2016 pre-halving pullback, if I go from the top tick to the bottom tick, there's 45 days. 45 days, all right? And it was before Bitcoin made another new high, a newer high, it was half a year, okay? So you have to understand, like, if you are involved in this asset, that it's entirely possible, like if we do the same sort of measurement here, we could go 30% down, brings us to, let's see, 30% down will bring us to about 51,000, and then 40% down would bring us to about 44,000, a little over 44,000. So it could dip that much in a pullback, like no problem at all. Right, the pullback so far has only gotten down to about 15%. So just be aware in terms of depth of correction, it could go down that far. And then in terms of length of time, if we go 45 days, that takes us past the halving. Okay, so that's a long time that we might potentially have to wait for price action to continue to the upside. And if it pulls back, let's say it pulls back 30 or 40%. If it takes 180 days to make a new all-time, or to make new highs after this, we're talking about September of this year before it does so. And so I think that that's something that people in crypto need to understand. You have to be careful. Obviously, Bitcoin is too volatile an asset to try to trade accurately from the, in terms of like trying to pick tops and bottoms of these moves. Because I just talked about what it often does, what it can do, but it doesn't mean it will do that. And so I think you have to be aware, of your risk. So looking at Bitcoin here, like Bitcoin is closing below, looks like it's going to, we still got an hour and 20 minutes, but it looks like it's going to close below this trend line that I drew. So maybe I'll draw it right there. So this is something to you're going to want to watch out for. You have to be able to risk manage this. So how do you do this? So you can pick a couple of the spots on the chart. I like to use red closes as kind of the way that I do it. Let's see here. Oh, sorry, that was a really bad line. So I've got kind of like the prime trend line here, and then I've got the base trend line here. So what you would typically do in a bull market, first of all, don't use leverage because you'll get wiped out on a decline like this. And you don't need leverage on an asset that goes at multiple hundreds of %. It's just not necessary. So don't take the risk. All right. But if you're prepared for the volatility, then what you do is you have your position, your base position, and then when you start getting these pullbacks, you have to find the trend lines, like you draw your trend lines, you find the places where price is most likely to find support. So I think this is what I was trying to draw. There we go. So I've got these three ascending trend lines. I've got the first trend line, and then the medium trend line, and then the base trend line, the prime trend line. So what do? Okay, so then take a partial position here, like add to it there, and then see what happens. Take a partial position here, see what happens. Take a partial position here, see what happens. But if we break down below that trend line and sustainably close below it, that's where you have to de-risk and get out because something is wrong. Okay. So if you go to that trend line is 30%. So at 30%, you're looking at, I mean, like if you're adding wisely, then you're basically setting yourself up for the next move up. So like if the next move goes, if the first move goes down to that 30% down mark, and then the next move goes, I mean, let's, imagine we go to 100,000. It's not going to go in a straight line, right? That's almost a 100% gain. That's really amazing risk to reward there and amazing returns. So you just have to be really careful. And I just don't think that people have enough respect for the fact that this pullback can take a really long time. To me, it's the time, like not even necessarily the depth of pullback, but the time of the pullback that really gets people. And so just be aware, because you've got all these people on Twitter that are talking about, oh yeah, the bottom is likely behind us. And it's like, really? I mean, we just made the all-time high, the most recent all-time high, a week and a half ago. What is that? Yeah, literally a week and a half ago. So you're telling me that after less than one full calendar week, we already made the low in the move, when these things can take like 30, 40, 50, 60 days to play out, like to bottom out. Just, and again, like I could be totally wrong about this. This thing could totally, go back up, from this spot. It could just rocket off. A lot of people think the ETFs have changed the game. So, but it could go up, but it might not. And history suggests that when you have this kind of price move for in such a short amount of time, you're going to have to give some of that back. So volatility is the name of the game with Bitcoin, and it's good. It's good to the upside, but understand both the value of the depth and the value of time in the pullback. So just be aware of that. Finally, a couple other things I want to say. I have no idea what happened with gold yesterday on Thursday. It was just up like a rocket above 2,200 and then sold back down. And so that was really interesting. And then gold was down today too. And I don't have updated positioning data, but I know that gold positioning has been getting, gold positioning not so much. People have been buying a lot of gold lately. But it's been silver. Silver had an outside reversal yesterday, and it was down again. Silver has been a big disappointment. Silver is still in the same range that it's been in for years, and it's well below. Let me see if I can. Still well below its old all-time high. So get out of the log scale chart. There we go. That looks a lot better, right? So yeah. Silver, the positioning in silver is extremely long. And again, this is one of those things where this is a psychology thing. So here's a quick lesson for you before we break off. So gold is at all-time highs. Gold has already taken off so much. Just since October of 23, and then especially over the last like 3 weeks, gold has taken off such that it's I guess if you want to say it this way, it's expensive. So people don't want to buy it. Well, then you have people on Twitter, and I'm not going to name names, but if you are on Twitter, then you know who these people are, the ones who shill silver all the time. They're the ones who are telling you, okay, that's crude. They're the ones that are like telling you to buy gold miners that have been telling you for months and years to buy gold miners, because they're going to catch up. Or telling you to buy, silver miners, they're going to catch up. Right? Well, anyone who's listened to these people who shill miners and who are telling you to buy silver because, silver is eventually going to catch up to gold and it's going to go to its all-time high above 50. And psychologically, people are going to buy silver versus gold because it's cheaper. I mean, what's the ETF for silver? SLV? SLV is 2256 right now. Right? What is GLD? GLD is 200. right? Just psychologically, people are going to buy silver, right? People are thinking about buying silver, right? But the problem is that they're already overpositioned and it hasn't happened, right? And I think the reason why is because the circumstances are different from like your typical gold or from your typical metals bull market. If we're actually in a situation where metals broadly are going to take off, then silver should be an outperformer. But if what's going on is not typically like the type of conditions conducive to a metals bull market, gold can go up, but it doesn't mean silver's going anywhere. So I would say is like unfollow all the people who have been telling you to buy miners and telling you to jump into silver because it's obviously going to outperform and it's gonna overtake. It's gonna go back up to its all-time high. Just unfollow them, okay? Because those people who have been telling you to buy silver because it's going to outperform, this is what they've gotten you. I mean, just like it's been down, okay, right? And over time, it's been down. So stop listening to them. And I just got a little fired up. But when people talk about the metals, like there are a lot of people out there who get a lot of attention for shilling gold and silver, and you know who they are, telling you to buy miners for like this whole idea of catching up, like the catch-up trade. That to me, like it's the same thing with crypto, right? With Bitcoin. Bitcoin is $63,000. Okay, that's too expensive for a lot of people. Even though you can buy partial, I know, I get it. You can buy partials, like you can buy like fractional Bitcoin. So, but it's too expensive. The number is too expensive for people. So that's why you get people going into stupid things like Dogecoin. Oh, it's only 15 cents. I can buy tons of Dogecoin. It's like, yeah, okay, like it's gonna rip. So people are. This is what alt season is. All right, let me go to something a little bit different. Like let's go to Litecoin. I know this is gonna get people mad at me, right? People buy something like Litecoin because it's cheaper. And they're expecting that, like once Bitcoin takes off, people are like, oh, I missed the move in Bitcoin. Well, I'm going to buy one of the cheaper coins. The other coins, the altcoins are higher beta, so they are going to move more than Bitcoin does once they start moving, right? But once people start chasing that for the catch-up trade, that's usually a signal that it's time for things to slow down or to pull back, okay? So or often it's a sign that everybody's already positioned, so or in the middle of positioning, and so the risk to reward on something on the catch-up trade, in my opinion, in my observation, is not good. So just be aware of that, all right? Because you're going to get yourself hurt, especially when there's a lot of really convincing people out there on social media who will tell you, oh yeah, buy silver, buy the miners. And people will go on and start levering up using futures, or they'll do margin in their brokerage accounts or something like that. They'll over allocate to one thing, expecting that because it's going to go up, then they're looking to make easy, quick money, and it's going to hurt you if you invest and trade that way. So just don't do it. All right. I think that's enough for there. I've already ranted for long enough. If you follow my newsletter, look forward to my newsletter on Sunday. It's going to be a good one. Thank you for watching this. I'll see you guys next time.